Hello everybody. In today's age of economic turbulence, the monetary policy of a country plays a major role in determining its financial stability. Today, we'll go all the way to Africa and comment on the monetary policy of Nigeria and assess it from a macroscopic point of view.
Now we come to the strategies of monetary policy in Nigeria. The strategy of monetary policy involves modifying the amount of base money M1 in circulation. This process of changing base money through the sale and purchase of government securities is called open market operations. Continuous market transactions by the monetary authorities modify the supply of money, which affects other market variables such as short-term interest and exchange rates. The distinction between the various strategies of monetary policy lies primarily with the set of instruments, targets, and variables that are used by the monetary authorities to achieve the desired goals. These strategies of monetary policy could be classified as monetary targeting, price level targeting, inflation targeting, and exchange rate targeting. We will now see some of the monetary policies used by CBN. Monetary targeting is currently being used by CBN. Under this approach, the target variable is the growth in money supply, designed to achieve the long-term objective of price stability. The central bank watches very closely growth in the monetary aggregates in order to predict the future size of money supply. If the monetary aggregates were growing too quickly, it could trigger inflationary pressures and cause the central bank to raise interest rates or otherwise halve growth in money supply. Price level targeting. Price level targeting is similar to inflation targeting in that both establish targets for a price index like the CPI. It takes past years' data into account when conducting open market operations. So if the price level rose by 2% in the previous year, the price would have to drop the next year in order to bring the price level back down to the 100 target level. This could mean more forceful action needed to be taken than would be required in the inflation targeting if inflation targeting were used. Inflation targeting. Inflation targeting is a monetary policy framework in which a central bank estimates and makes public a projected or target inflation rate and then attempts to steer actual inflation towards the target through the use of interest rate change and other monetary tools. The likely actions of the central bank to raise or reduce the policy rate become more transparent under inflation targeting. If inflation targeting is above the target, the central bank is likely to raise the policy rate and vice versa. Under the framework, the investors know the target inflation rate and therefore can more easily anticipate the interest rate changes and factor these into their investment decisions. Exchange rate targeting. Under exchange rate targeting, the value of currency is fixed in relation to another currency or a basket of currencies. This facilitates trade and investment between the two countries. It is very useful when external trade forms a large part of the GDP.
Like any other country, monetary policy in Nigeria guides the central bank's supply of money in order to achieve the objectives of price stability, full employment, and growth in aggregate income. This is necessary because money is a medium of exchange and changes in its demand relates to supply necessitates spending adjustments. To conduct monetary policy effectively, the central bank adjusts the policy rate or the exchange rate in order to affect the variables which it does not control directly. The instruments of monetary policy used by the central bank depends on the level of development of the economy, especially the financial sector. These instruments could be direct or indirect. Direct credit control. The central bank can direct deposit money banks on the maximum percentage or amount of loans, that is, credit ceilings, to different economic sectors or activities, interest rate caps, liquid asset ratios, and issue credit guarantees to preferred loans. In this way, the available savings is allocated in investment directed in particular direction as desired by the authorities. This instrument is used by the central bank to influence the level of bank reserves and hence their ability to grant loans. Reserve requirements are lowered in order to free reserves for banks to grant loan and thereby increase money supply in the economy. On the other hand, they are raised in order to reduce the capacity of banks to provide loans, thereby reducing money supply in the economy. Open market operations. The most important and flexible tools of monetary policy is open market operations. It is the buying and selling of government securities in the open market, that is, primary or secondary, in order to expand or contract the amount of money in the banking system. By purchasing securities, the central bank injects money into the banking system and stimulates growth, whereas by selling securities, it absorbs excess money. Thus, if there is excess liquidity in the system, the central bank will, in a bid to reduce the money supply, sell the government securities such as treasury bills. On the other hand, in periods of liquidity shortage, the central bank buys government securities so as to increase money supply. Instruments commonly used for this purpose include treasury bills, central bank bills, or prime commercial papers. Discount window operations. This instrument is a facility provided by the central bank which enables the DMBs to borrow, reserve against collateral or other acceptable securities. The central bank operates this facility in accordance with its role as lender of last resort, and transactions are conducted in form of short-term loans. The central bank lends to financially sound DMBs at the policy rate. This rate sets the floor for the interest rate regimes in the money market and thereby affects the supply of credit, the supply of saving, and supply of investment. Let us understand the exchange rate in context of Nigeria. The balance of payments can be in deficit or in surplus, and this can affect the monetary base and hence the money supply in one direction or the other. By selling or buying foreign exchange, the central bank ensures that the exchange rate is at an optimal level. The real exchange rate, when misaligned, affect the current account balance because of its impact on external competitiveness. The central bank may require DMBs to exercise particular care in their credit operations in order to achieve specified outcomes. Key elements of prudential guidelines remove some discretion from bank management and replace them with rules. Moral suasion. The central bank issues licenses to DMBs and regulate the operation of the banking system. Thus, it can persuade banks to follow certain policies such as credit restraints or expansion, increase saving mobilization, and promote exports through financial support, which otherwise they may not do on the basis of their risk-return assessment.
Now we will talk about the monetary policy management, wherein we will discuss about various institutions or committees that play a vital role in the formulation and execution of monetary policy of Nigeria. The Central Bank of Nigeria is the monetary authority in Nigeria. In 2007, the central bank created Monetary Policy Committee, which is solely responsible for the monetary policy decision. The committee meets bi-monthly for policy decisions under the chairmanship of Governor of Bank. There are also other committees involved in the monetary policy management. These are the other committees that all come under the Monetary Policy Committee. Let us discuss these committees one by one. First comes the Monetary Policy Technical Committee. This committee keeps track of economic and financial system developments on monthly basis and provides technical documents on issues of interest for the MPC meeting. Next comes Monetary Policy Implementation Committee. This serves as the implementation arm of the Monetary Policy Committee. The committee is responsible for implementation of monetary policy as decided by the Monetary Policy Committee. It meets weekly to assess the liquidity position of the banking system and reviews issues regarding the banking system infrastructure as well as the health of banking system. The next committee is Liquidity Assessment Group. This committee meets daily to assess the liquidity situation and to suggest policy actions to be taken on each day in both the foreign exchange as well as the domestic money market. It follows up with the implementation of monetary policy measures and reports it to the MPC, which is Monetary Policy Committee. Then it's Fiscal Liquidity Assessment Committee. Now the responsibility of this committee includes providing information on the operations of Treasury to the Liquid Assessment Group so that the Liquid Assessment Group can do forecasting levels of liquidity in the economy. It is also responsible for providing policy advice on fiscal issues to the management of bank. The other committees, annual Monetary Policy Conference and Quarterly Monetary Policy Forum, as well as Monetary Policy Advisory Group, they assess the developments in the economy and suggest broad directions for monetary policy.
Now let us have a look at the monetary policy of Nigeria. The Central Bank of Nigeria has adopted a two-policy framework, exchange rate targeting and monetary targeting. Exchange rate targeting policy was used from 1959 to 1973. The Nigerian pound started off by pegging itself with respect to the British pound, but the devaluation forced them to change the pegging to a more stable US dollar. The global crisis of the 1970s due to the devaluation of the US dollar worried the authorities, and hence in 1978 they decided to peg their national currency, Naira, to a basket of 12 currencies. The global crisis pushed the Nigerian economy to undergo several structural changes. Newly found oil reserves strengthened the exports and helped increase the revenue. This led to a growth in the public expenditure and added to the inflationary pressure. Hence, they shifted to a new framework of monetary targeting. The monetary targeting was concluded with the help of direct and market-based instruments. The focus of this policy was to curb inflation while sustaining growth. This was done by setting targets for inflation and demand expansion, which would assist them in achieving their goal. The following two clips deal with the change in the direct control system with regard to the economic condition over the period of time, where it starts with the need to maintain a sound currency in 1960 to 62 and moves over to focusing on the developmental issues. The state of economy in 1964-65 was of a detrimental BOP, and hence credit rationing was applied, which was lifted in 1966 to support the civil war. The aftermath of the war led to the government reducing their reliance on the banking system. The period from 1970 to 1980 had several key highlights. A few of them include an unchanged CRR, priority sector lending reforms, credit controls, and a marginal upward adjustment of interest rates. Rising interest rates to encourage savings and investments reduced the demand for foreign exchange. Notwithstanding these rigid monetary controls, the economy shifted to use of indirect controls.
Now, we will be talking about the indirect control mechanisms. The Structural Adjustment Program that was held during July 1986 instituted an efficient market system for allocation of resources to eliminate the excessive controls established in the previous 2 decades, which were inhibiting development. The 3-step approach to achieve the goal included exchange control liberalization, adoption of relevant pricing policies in all sectors of the economy, rationalization and restructuring of public expenditure, and customs and tariffs. As a result of financial deepening and economy-wide macroeconomic reforms that commenced mid-1980s, the CBN shifted to market-based instruments including OMO, cash reserve requirements, discount window operations. In May 1989, the federal government directed all public sector accounts to be withdrawn from the banks to reduce the banking system's liquidity. In 1999, it announced a reversal of the same measure to infuse liquidity in the system when the retail functions were transferred from the Central Bank of Nigeria to deposit money banks, also known as the DMB. Other policy measures like adjustment of CRR, abolition of monetary credit allocations, rationalization of sector credit controls, deregulation of interest rates, shift to use of OMOs, etc. were initiated. Thus, there was a paradigm shift from the direct to indirect system of control to eliminate the distortion and inefficiencies in the financial system caused by prolonged administrative controls. Banks and other operators were also infused in the financial system. The 2 major policy regimes can be identified as short-term and medium-term. In this section, we will be talking about the short-term and the medium-term monetary policies of Nigeria. In 1986, monetary policy was refocused based on the 1-year perspective. OMO, which was conducted wholly using Nigerian treasury bills, which are also known as NTBs, continued to be the primary instrument of monetary policy. Other policy instruments employed include the discount window operations, mandatory sales of special NTBs to banks, and a requirement of 200% treasury instruments to cover for banks' foreign exchange demand. Interest rate policy was deregulated through the proactive adjustment of the minimum rediscount rate, also known as MRR, to signal policy direction consistent with liquidity conditions. The official and interbank exchange rates were also unified in 1999. The medium-term monetary policy of Nigeria included CBN commencing a 2-year medium-term monetary program aimed at freezing monetary policy from the problem of time inconsistency and minimizing overreaction due to temporary shocks. Under the medium-term monetary policy, guidelines are open to half-yearly review in line with developments in monetary and financial markets. There is a need for a more competitive financial sector geared towards improving the payment system. The CBN has also continued to ensure banking, soundness, and financial sector stability, not only to ensure the effective transmission of monetary policy to the real sector, but also to enhance the efficiency of the payment system. In order to set an operating and intermediate target, a consolidated balance sheet of the banking system is obtained. Then, financial programming is used to determine the optimal supply of the money according to the predetermined ultimate targets. The underlying premise is the quantity theory of money, that is MV equal to PY. The outcomes of this framework were mixed. Growth in monetary aggregates were better than the target substantially in most of the years. Inflation rate outcome was single digits for 2006 and 2007, but reverted back to double-digit figures in 2008 due to global food shortages and financial crisis. One of the major challenges has been the unreliability of revenue and expenditure forecasts, since budget size is largely determined by the oil revenue. Any change in oil prices and production volume renders the forecast errors very high. Unstable revenues arising from global oil prices increases the budget deficits and impairs the goal of monetary policy, especially when the government is compelled to be dependent on the banking system to meet its financial needs. The lack of coordination among different tiers of the government is also a challenge to this. Macroeconomic coordination between all the tiers of government need to enact fiscal policy. According to the current revenue sharing formula, almost half of the total revenue is allocated to lower tiers of the government that are also responsible for more than half of the total government expenditure. Lower tiers have significant independence in taking their expenditure decisions, thereby influencing the implementation and design of the fiscal policies. Budget transparency and public expenditure management system has to be adopted for monetary policy challenges have to be alleviated. Concluding the whole affair, the monetary policy in Nigeria over the last few years was either expansionary or contractionary. It was also noted that the strategies of monetary policy involved modifying the level of base money in circulation, which will in turn affect money supply, inflation, and output. The instruments and target variables used by money authorities in implementing monetary policy were also probed in detail. Thank you.